Welcome to Acme Digital, the #1 channel to help you improve your financial literacy. Here we provide contemporary financial information and practical ideas that you can implement in your business or personal finance to be on your way to financial freedom. Investing can be confusing and difficult, but there are some basic facts that, if you are familiar with, will give you a fair advantage when entering the world of investing. By investing your money regularly, you may be able to increase it many times over with time. That's why it's important to begin investing as early as possible and as soon as you have some money saved for that purpose. If you are like me, you might have considered investing some of your savings to get some more money in return. Perhaps you want to ultimately get enough money to finance a big financial goal, like buying a house. Before you make a decision to invest, ensure that you are placing your money on the most appropriate investment option. There are several options that you can use to invest your funds in. Cash in hand or cash kept in a savings account loses value over time due to inflation. Investing allows your money to grow independently, combating the effects of inflation. Without investing, inflation eats away at your savings. First, let's define the term investing. Investing is the act of allocating resources, usually money, with the expectation of generating income or profit over time. It involves purchasing assets with the goal of increasing their value or earning returns. Investing is a way to grow wealth, whether for long-term goals like retirement or short-term objectives. It's important to understand that investing carries risks. The value of investments can fluctuate due to market conditions, economic factors, or other unforeseen events. People often diversify their investments to spread risk and potentially increase their chances of returns. Successful investing typically involves careful research, analysis, and a long-term perspective. Different investment options have varying levels of risk and potential return, so individuals often choose investments based on their financial goals, risk tolerance, and time horizon. Investments come in various forms, each with its own characteristics, risk profiles, and potential returns. Let's explore some common types of investments. 1. Stocks. This entails ownership in companies. Investing in stocks means purchasing shares of a company. Shareholders participate in the company's growth and profit through dividends and capital appreciation. Stocks offer the potential for high returns but also come with higher volatility and risk. 2. Bonds. Bonds, a form of debt securities, are loans made by investors to governments or corporations. They pay periodic interest and return the principal amount at maturity. Bonds are generally considered safer than stocks but offer lower potential returns. Risk varies based on the issuer's creditworthiness. 3. Mutual funds. A form of pooled investments, mutual funds collect money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They offer diversification and professional management but may have management fees. 4. Exchange-traded funds, also known as ETFs. Similar to mutual funds, ETFs pool money from investors to buy a basket of assets, stocks, bonds, commodities, but trade like individual stocks on exchanges. They offer flexibility, lower costs, and intraday trading compared to mutual funds. 5. Real estate or physical property. Investing in real estate involves buying physical properties, residential, commercial, or real estate investment trusts. Real estate investments offer rental income and potential property appreciation but require significant capital and management. 6. Commodities. Physical or financial goods. Commodities like gold, silver, oil, or agricultural products can be invested in directly or through futures contracts. Futures contracts are a type of financial derivative agreement between two parties, typically to buy or sell an asset at a predetermined price on a specified future date. These contracts are standardized agreements traded on exchanges, facilitating hedging or speculation on the future price movement of the underlying asset. 7. Alternative investments. Alternative investments like hedge funds, private equity, and others are less traditional investments, often involving higher risk and less liquidity than conventional assets. Access to alternative investments is often limited to accredited or sophisticated investors due to their complexity and risk. 8. Certificates of deposit and savings accounts offer low risk options with guaranteed returns, albeit generally lower compared to other investments. They provide liquidity and safety of principal but with minimal growth potential. Each type of investment has its advantages, drawbacks, and suitability based on an individual's financial goals, risk tolerance, and time horizon. Diversification across different asset classes can help manage risk in an investment portfolio. Diversification is spreading investments across different asset classes or sectors reduces risk. Like I mentioned before, you might have a definite goal in mind to achieve with your investment option. Some people invest for rapid wealth growth. This often involves higher risk because high returns typically come with increased uncertainty. Here are a few options known for potential high returns, but they also come with higher risks. 1. Stock market. Investing in individual stocks or exchange-traded funds, ETFs, can offer high returns. However, the stock market is volatile, and picking individual stocks can be risky. It's essential to research and diversify your investments. 2. Cryptocurrency. Assets like Bitcoin and Ethereum have seen rapid growth, but they are highly volatile and speculative. They can offer significant returns but are also subject to substantial fluctuations. 3. Real estate. Buying property or investing in real estate investment trusts, REITs, can generate substantial returns through rental income and property appreciation. However, real estate markets can be cyclical and require significant capital. For venture capital and startups, investing in early-stage companies or venture capital funds can yield high returns if the company succeeds. However, it's also a high-risk, high-reward scenario as many startups fail. 5. High-risk bonds and derivatives. Certain bonds or derivative products might offer higher returns, but they often come with a higher risk of default or loss. While these options have potential for quick growth, they also carry significant risks. It's crucial to consider your risk tolerance, investment horizon, and diversification strategy. Generally, seeking rapid wealth growth often involves a trade-off between risk and potential returns, so it's essential to balance these factors according to your financial situation and goals. Consulting with a financial advisor can also help tailor investment strategies to meet specific objectives while managing risk. Let's take a deeper look at stocks and a few other concepts. Understanding these foundational concepts is crucial for anyone looking to venture into the stock market, as they form the basis for making informed investment decisions. Stocks, also known as shares or equities, represent ownership in a company. When you buy shares of a company's stock, you become a partial owner of that company. The stock market facilitates the flow of capital from investors to companies. Companies issue stocks as a way to raise capital for various purposes, such as expanding operations, investing in new projects, or paying off debts. Investors provide funds by purchasing stocks, which companies use. Investors buy these stocks with the expectation that the company will grow and the stock's value will increase over time. Stocks can be categorized as common or preferred. Common stocks represent ownership and voting rights in the company, while preferred stocks typically offer fixed dividends but usually do not have voting rights. Companies must meet specific requirements to list their stocks on an exchange, including financial reporting standards and regulatory compliance. Investors face the trade-off between risk and return. Higher risk investments often offer higher potential returns but come with increased uncertainty. Diversification aims to minimize the impact of a potential decline in any single investment. What is asset allocation? Asset allocation involves allocating investments across various asset classes, stocks, bonds, real estate, based on risk tolerance, time horizon, and financial goals. What does market volatility mean? Stock prices fluctuate due to market forces, economic conditions, company performance, and investor sentiment. Volatility can present opportunities but also risks for investors. The market reflects the collective expectations, beliefs, and information about a company's future prospects. Liquidity and efficiency. Stock markets provide liquidity, allowing investors to buy and sell shares easily. Efficient markets ensure fair pricing and information dissemination. Let us examine the difference between the stock market and a stock exchange. Stock exchange is a specific platform or marketplace where securities, primarily stocks and other financial instruments, are bought and sold. It's a regulated marketplace where buyers and sellers come together through intermediaries like brokers or traders to execute trades. Examples of stock exchanges include the New York Stock Exchange, NASDAQ, London Stock Exchange, and Tokyo Stock Exchange, TSE. Each stock exchange has its own rules, listing requirements, and trading hours. Function: exchanges facilitate the trading process, ensuring transparency, liquidity, and fair pricing for securities. The stock market is the broader concept encompassing all the exchanges and platforms where securities are traded, while a stock exchange refers to a specific entity where these transactions occur. What is equity crowdfunding? Equity crowdfunding is the online offering of private company securities to a group of people for investment, and therefore it is a part of the capital markets. Because equity crowdfunding involves investment into a commercial enterprise, it is often subject to securities and financial regulation. Equity crowdfunding is also referred to as crowd investing, investment crowdfunding, or crowd equity. Equity crowdfunding is a mechanism that enables broad groups of investors to fund startup companies and small businesses in return for equity. Investors give money to a business and receive ownership of a small piece of that business. If the business succeeds, then its value goes up, as well as the value of a share in that business. Coverage of equity crowdfunding indicates that its potential is greatest with startup businesses that are seeking smaller investments to achieve establishment, while follow-on funding required for subsequent growth may come from other sources. So far we explained what investment is, what it entails, the different types of investments and investing in the stock market, and the key concepts that beginner investors should be familiar with. In our next video, we will look at what a beginner investor should do before starting to invest. We have come to the end of this video. If you found it interesting and informative, please like, share, and subscribe. Join us for more great content on investing in the next video. Thank you for watching.